Please welcome the panel on M&A, Moving On and Up, moderated by Bloomberg TV anchor Romaine Bostick.
Yeah, they really assembled a great panel here with Alan, Andrea, Anu, Ron. The whole gang is here right now, and we talk about this idea of M&A and maybe the resurgence of M&A. I guess the big question is, did it ever really go away? I know volumes dropped, but when you look at what actually has been transpiring over the last couple of years, what did that tell you about where we are? And Ron, since you're staring at me intently, I'll start with you.
Well, it's an interesting question. If you compare, for example, the M&A market to what happened in the IPO market, where I spend a lot of time in the tech sector, the IPO market went completely dormant in 2022 and 23. M&A is more steady. We have seen an environment over the last couple of years where things slowed down, largely because of the interest rate environment. But we're seeing some green shoots, and I'll give you one statistic. If you look at deals over $1 billion in the last 12 months, those types of deals are up 26%. So HP Juniper, Synopsys, Ansys, Capital One Discover, we're seeing larger transactions, which I think is a sign of a healthy market. But M&A overall, to your point, it's more resilient than other aspects of the capital markets.
But are we seeing that beyond just, obviously you have a big focus on tech. I know we've seen some activity in healthcare. How broad-based right now is the M&A activity? I'll start with you. Andrew, sorry.
Oh, me, yeah. Look, we're seeing a very broad-based activity. Unlike some other time periods where you see a heavy concentration in areas like tech or telecom or energy, we're really seeing activity across our entire platform and across geographies. And I think one sentence I would add on to what Ron said is that M&A is not a short-term market trend. It's a long-term corporate strategy, and it's here to stay. We're going to have movements, and we're going to have cycles within a long-term secular growth of M&A, which we're seeing in 22 and 23. 24 looks a bit better. I would echo what Ron said about larger deals, but you're going to have a $2.5+ trillion market. May not get to 5 this year. I don't think that's in the cards, but you're going to have a $2.5+ trillion market, and that's a big market.
Andrea, your firm has done a lot of research on optimism in the market, and where does that optimism stand? What do those surveys show right now?
Yeah, thanks. We ran this pulse survey, which basically we interview more than 1,200 CEOs and investors, and just try to understand what the sentiment in the market. And the last issue, actually, we recorded an uptick and in the overall confidence, both in terms of the overall market situation, the outlook, but also specifically regarding M&A, with CEOs much more prone to enter into M&A situation, and in particular, much more willing to divest. The interesting point is really that 71% of the respondents actually are considering some form of divestment, spins or a carve-out. And this is particularly interesting because it can really represent a way to reignite the overall M&A market. It has been really subdued during the last financial year. Speaking up over the last 4 months, I think in the last 4 months we see much more activity, in particular larger deals. So we had to date 20 transactions exceeding the 10 billion value mark. So that's considerable, considering also the fact that the last year these kind of big deals were almost non-existent. So there's a sign, concrete sign of optimism coming from the numbers, the stats, and also I think coming from our CEO survey.
And there's been a lot of take-privates as well, or at least take-private attempts on new. I'm curious from your side of the world, your corner of the market here, what is actually driving, I guess, some of that activity, particularly on the take-private side?
So take-private was one of the things which didn't happen a lot of last year, and so the comparison year over year, I think it's up about 25%. So there's a combination of things driving that. One is you've had re-rating of equity market valuations. Little bit more of an acceptance of reality of the new valuation, such that you're willing to transact on the basis of that. More stable, available credit, even if it's at a higher cost. And a fundamental mismatch between private and public market valuations. The challenges of being a public company. So you put all that in the blender, and then out comes more take privates. Now, a natural question is, why don't we see more? I think if we had a better interest rate environment and less buyer-seller valuation mismatch, we would see more of it.
I'm curious, and part of what you just said, I mean, you kind of mentioned some of the, I guess, challenges, if you will, for financing. Alan, I am curious, from where you're perched here, has the opportunities for financing these deals, are they better now than maybe what they were a year or two ago?
You know, the markets tend to have stabilized given the interest rate environment. However, we see markets as continue to be fickle. Right, you seem to go through cycles, and sometimes those cycles could be as short as a week or two, where it appears that the window is open and financing markets are very robust. And not surprisingly, you see the corporate activity really pick up, and you've seen that because they can react quickly, as all of my colleagues have already started to articulate, that the M&A cycle being much longer and you're looking at financing further out, that aspect of the decision-making and how that fits into the quotient around whether or not to move forward with the transaction is more relevant today than ever. And part of what we've seen as a response to that environment is more all-stock deals, right? So, for example, we've seen this year just a higher percentage of our clients looking to use their paper as their currency as opposed to exposing themselves to potential financing markets. So better today than it has been for a while, but something you really have to watch day to day and week to week.
Well, that's good for the larger companies that are in the publicly traded companies that have the stock to do that. For more middle market companies, those that either aren't public or are going to have to rely on debt financing in some way. I am curious, and I'll pose this to you, Andrea, about how much activity we're seeing there and whether financing conditions are holding it back.
Yeah, I think that if you look at the current market, in particular the private equity market, for example, I mean, it's obviously that the interest rate impact is severe, and the last 12 months were really muted, and there has been a pickup in activity in this quarter, in particular in April. I think in April, the private equity deals total at almost $80 billion, which is a very good month, but actually down in volumes. So it's, again, it's a mixed picture that we are seeing. And until the interest rate settles, I mean, it's very difficult for them really to enter into this sort of transaction. And there is something like 28,000 portfolio companies that are waiting an exit. So that's really the kind of conundrum we are in.
Is most of the activity, are we going to see it primarily within the U.S.? Are we going to see more stuff overseas? Are we going to see more cross-border transactions? Are cross-border transactions, at least involving the U.S., is that even a possibility now at scale? Anu?
The cross-border has been muted for a while, right? First, because of the pandemic, and then I'd say much more regulatory. And in Europe, you have two land wars, which I think affects the psyche in Europe a lot more than it does in the United States. I'm not expecting a dramatic change to cross-border volumes in the near term. The lack of regulatory certainty in terms of if a non-American company wants to buy an American company, what could the outcome of that be? Especially in an election year, nobody wants to become the poster child.
Yeah.
So I think there is a little bit of, the interest in the US markets is very high. And so people want to be in the US market. The way you're seeing that trend is you're seeing several UK companies do a demerger or a listing or a deal with a US company to try to benefit from the valuation mismatch between UK and US. And UK target M&A has also seen an increase this year. So those are two spots in the cross-border market. There's a little bit of activity from Japan, But outside of that, I'm not that optimistic about the return of cross-border.
So Andrew, I mean, let's say I'm a foreign company, a large foreign company, and I come to you for advice. I've got an idea, a US-based company here. I mean, what do you tell them? I mean, what is kind of the lay of the land that you give them right now in pursuing that deal?
Well, look, I think globally you're seeing the U.S. enjoying not only king dollar but also king markets, right? So the global equity value right now stands at about $110 trillion. About 47 trillion is in the U.S. So about 45% of all global equity value is in the United States. It's one of the reasons why you have non-U.S. companies, particularly in Europe, looking at listings in the United States, looking at dropping assets into U.S. publicly listed companies because you're getting premium valuation for liquidity. So it's not about earnings growth as much. Emerging markets have much higher earnings growth than U.S. publicly listed companies, but liquidity is king, and the valuations are at a premium relative to Europe. What we see in the broader landscape in the U.S. is a much more activist regulatory regime for sure. That's not idiosyncratic to the United States. We're seeing it in the UK. We're seeing it in Brussels. It is a time where I'd echo Anu, I think said it, Ron said it. It's more about bringing buyers and sellers together. I think buyers are really picky, and sellers are still stubborn. And so that creates, a bit of a plumbing problem. We have a lot of backed up M&A that I think is coming, and it's in the pipeline. But that's really been the issue, an inhibitor to transactions. I don't think it has anything to do with financing. That's a controversial thing to say maybe in a world where we've got trillions of dollars of capital here present at the conference, but there's a surfeit of capital, the availability of it, and the avenues to get it. And so that's not really been the issue. It's
but
more
there's
about
also the
buyers
willingness
and
to
sellers.
strike a deal, and as you're alluding to, and I think as Anu just talked about, that gap between how a buyer views the valuation and how the seller views the valuation. I know that gap has been wide, but has it narrowed at all?
I think it is narrowing. You're seeing an increase in transactions. We've just crossed $1 trillion in announced M&A. We're sitting here in May, so that's good early indicator. We do have 30% of transactions being either all stock or a mix of stock and cash. We have all the ingredients for ignition here. I've kind of been talking now for a while that I don't believe it's a vertical liftoff in a SpaceX rocket on M&A. It's going to be a runway 787. It's going to take off. I think we see the flight plan. It looks pretty good. There are going to be some air pockets along the way. The Fed's reporting $5 trillion of cash on non-bank balance sheets. The ECB's reporting $1.5 trillion. You've got private capital strategies with over $4 trillion, a lot of it represented at this conference. There's a ton of dough out there. That combination is larger, just to give you some scale and context, it's larger than the GDP of Germany and Japan combined. That's how much dry powder's out there. It's not going to get done in 24. It's not a 24 story. Long-term growth in M&A, we all believe in that.
Andrea?
No, I just wanted to add to this. Again, coming from our last survey, more from a qualitative point of view, there's a clear evidence from the feedback coming from the CEOs we interviewed that they are getting more accustomed to this level of uncertainties. I think it's 23, I think it was a year where corporates, private equity could actually afford to wait and see. I think 24, if you look at also our interactions with clients, etc., the mood has changed. It changed dramatically. So they cannot wait any longer. I think they need really to take advantage of all the possibilities of new technologies and also the change in the geopolitical situation that poses a lot of threats, but also a lot of opportunities. So there has been really a shift in the mood, which is pretty evident looking at, again, anecdotally, the pipeline of the client of ours. You can see that are building pipelines in a completely different manner than 12 months ago. So it's really the kind of feeling that says this is not going to be different in 25, 26, 27. You need to act now. You need to take advantage of the situation, which I mean, it was a completely different mood last year.
It's interesting.
Because the organic growth that people had in terms of inflation-driven top-line growth, because even if you look at all the private equity exits, about 50% of their value creation came from top-line growth. And that kind of has died down, and you still have a lot of margin pressure. And so where is the solution? You need a tech solution, you need supply chain solution, you need growth solution. And M&A affords you that solution. And the cash that you have that Andrew talked about allows you to do that and go buy that solution.
But this is really the challenge. So as long as equity investors demand a 10, 12, 14% type return, the price increase is already reflected. You're not going to get a whole lot out of price increase. You got to work the middle of the P&L a little bit. You'll have dividends. You'll have some buybacks. Then you have M&A.
Yeah.
And so we're at that stage where these other tools that executives use to drive earnings are being utilized and exhausted, and now you're on to the next stage. And I think just to, again, to play off of Alan and Ron and what Andrea said, it's, you know, we're in a, M&A is a conviction market, right? It's not a prediction market. So you buy stocks, you sell stocks, you buy and sell bonds, you take positions. Those are predictions about where future prices are going. In M&A, you have to have conviction. It is a long-term marriage with whatever asset you are buying. And in the case of selling, it's a long-term divorce. So you've got to be comfortable either bringing it on or letting it go. And that's not something that's done overnight. Yeah. So all of us see all the planes on the runway getting ready to take off. Right. But the public only sees the ones that are in flight.
That's a good point. And Ron, you were...
I just wanted to add some perspective on the impact of higher rates to the private equity part of our market. Year in and year out, private equity as either buyer or seller is now over 50% of the M&A market. It's significant. The impact of the 10-year Treasury, Fed funds, and global interest rates on that asset class in terms of being able to generate IRRs of 20+% is shocking. So let me give you one statistic. The average LBO interest rate for a typical leverage loan last year was over 10% for an LBO. In any of the prior 15 years, it never hit 7%. So we're talking about a 300 basis point increase in funding costs for private equity firms in the M&A market. The other thing that's interesting is a typical LBO in the past used to be maybe 30% equity, 70% debt. Because the funding costs have gotten so high, last year also for the first time, equity was over half of the typical capitalization of M&A deals. What does that mean? It means returns are harder to come by. It's harder to get to that 20% IRR return for private equity firms. But at the same time, to Andrew's point, there's a lot of dry powder. They have to spend that money. LPs aren't investing in private equity firms to have them sit and wait for rates to go down. So you would think valuations would be coming down. They are a little bit, but the reason why valuations have remained resilient, certainly in my sector in tech, is the amount of dry powder out there that has to be put to work. So at the end of the day, what I think is going to happen in that asset class, in private equity in particular, is 20% IRRs are going to be harder to come by. I think you will see limited partners being willing to accept 15%, 18% IRRs as opposed to 20%. It has become so competitive with rates so high, that's the impact of what we're seeing. And that's about half the market.
Yeah. Alan, I'd like to get your thoughts on that as well.
Sure, and clearly as was pointed out, you've seen a complete shift in the sponsor market. We see that as somewhat temporary, however, right? That as you point out, the investment returns that the LPs have become accustomed to are in the high teens. And ultimately, for that market to thrive the way it has, 50% plus equity checks is not sustainable. Our view is that for the sponsor community that's putting the capital to work, they're finding great opportunities and great companies. Our view is the bet that they're making is that 12 months, 24, 36 months from now, when markets normalize, they're levering those companies up more appropriately at cost bases that make sense, right? If you think about, again, a 10% cost of capital, if you lever a company 6 times, you've destroyed your EBITDA and your ability to grow and invest. So the math is pretty straightforward that you have to adjust for at a 10% interest rate. So our view is that that market has stabilized such that people are doing transactions. It's better. It's not great. The gap between buyers and sellers is still there. You know, we talk about planes on the runway. It's the portfolios that have to be sold and monetized that really has to kickstart this next phase of really robust M&A. And financing markets hopefully adjust as well, such that all those pieces align and we get a really robust environment somewhere 25, 26.
Right. And let me add another element which is less financial, but I think is on top of every private equity partners. I mean, the historical traditional tools to create value, working capital improvement, the cost reduction, etc. Again, still very valid, still effective. But today, I think with AI and with all the opportunities actually to use AI, not just to build efficiencies, but also to change really the business processes, this is posing a huge question mark regarding how they actually can create value. And I think it's unclear how this can work, and it's unclear for the private equity to understand who can help them through this process. So there is also, I think, this perception that the entire value creation process may be actually transformed beyond recognition by new technologies, AI, etc. So again, wait and see in this moment could actually make sense. Yeah. But for how long? But this is an additional element of complexity that they have to face.
But when you say transformed in a good way?
A good way, yes.
Maybe. There's been, I'm going to start to weave in some of the questions from the audience, and if you have a question for any of the panelists up here, just use the QR code and I will relay it to them. I want to get to one of the audience's questions, and I'll pose this to you, Alan, and this gets to the idea of the dollar's strength, and it gets back to the idea of cross-border deals and whether the dollar's strength might aid that with U.S. companies looking for deals.
You know, the dollar strength, if you'd have asked an economist 20 years to close their eyes and talk about the U.S. having $35 trillion accumulated deficit, $1 trillion annual deficit, they would have said, wow, the dollar's collapsed. Right? This is unheard of in the current economic environment. They have a dollar as strong as it is, which is, if anything, a reflection of the rest of the world, right? So it's a reference currency relative to everybody else. So we live in such unusual times. The dollar strength is really just reinforcing for, as we think about our global companies, why you need to have exposure, right? So it goes back to whether it's 45% of the equity capitalization globally. You're very hard pressed if you are a global company today, or even a regional or geographically limited organization, not to have exposure to the US dollar, such that you're not balancing out your costs, your revenue, so that you're in a place where you can have relative exposure. And that's why we're seeing a number of companies looking to get exposure to the US, not just for the strength of the equity market, or sorry, the strength of the economic market and what's obviously been a stronger US economy than most of us anticipated at this point of the year or this point of the cycle, but it's about being balanced such that your P&Ls are balanced and your currency exposures are a little bit balanced out, and that is part of what we're seeing as a driver for acquisitions here in the US. So it's part of the equation for considering opportunities. I wouldn't say it's the primary driver. You know, it always goes back to what's the industrial logic, right? The one thing that, you know, we dove right into it, but feel like has not been lost in this environment is the strategic logic of M&A. That, you know, to me, that discipline, maybe the bar's gotten a little bit higher given the economic and the market and the financing environments and everything else that we're dealing with. But to me, the industrial logic continues to be very disciplined, very strong. and where companies see opportunities to strengthen their operations, solidify the risks or manage their risks better, whether they're currency risks or economic exposures. That's really what's driving these transactions.
Andrew, you have any thoughts on that? Andrea?
Yeah, no, I totally agree. And if you look at, again, some of the feedback we got from institutional investors, also part of our interview, I mean, they are expecting much higher return from M&A than in the past because the risk is higher in this moment, so the hurdle is higher. And the industrial logic, I mean, it's really the key driver for many of these transactions. And if you look at this disproportionate amount of CEOs looking into disposals, I mean, you can clearly see the other side of the coin. I mean, they need really to rationalize their operations. They need really to get more capital to focus on where their strengths are. And the only way to do this actually is relinquish some of the non-core part of their businesses, being divisions, business units in the retail space, maybe product lines, where they are not number one or number two. So they need really to do this and invest that amount of capital in new technology, process innovation, and possibly market entries in those markets where we think that due to the geopolitical situation, there's an opportunity to grow. And this is really causing a lot of the M&A activity we are seeing now, and we predict is going to happen in the next 6 to, say, 12 months. So it's much more strategic, less financial, I would say, from a corporate perspective.
Yeah, both these themes, right, portfolio optimization and corporate clarity, they've been strong for a while in the market. And now I think people are approaching it, yes, a pipeline for divestment, but also a lot of it as self-help. Is I'm not going to wait for finding a buyer or something like that. I'm just going to do a spin, split, demerge, list the North American business in North America. And then if something else happens in terms of a buyer showing up, so be it. But there is a base path that is self-help, which also has the benefit of an easier regulatory process in the sense that you're not getting an M&A deal approved. And then if there is a second step, then so be it. And that portfolio optimization is a lot more nuanced than the sum of parts. I think it's more to what Alan was saying in terms of looking at where do your cash flows come from, what currency are they in, what are the risks that you're taking, and how do you more responsibly balance the inherent risk in the business, and accordingly think about whether something is core or non-core, and whether it is better off being separate or a part of you. So much more of a strategic approach to thinking about portfolio.
I would just add, we are in an environment in which U.S. buyers should be having a field day. The strength of the dollar and the depth of our capital markets here in the U.S., it's more liquid, it's healthier than, in particular, in Europe, but certainly Asia as well. We worked on a transaction last week of a UK company, to Anu's point, which went private and was acquired by a US-based private equity firm. In spite of the cost of funding, and in spite of the potential cross-border regulatory risk. So I think one of the things that's holding back cross-border M&A, in spite of how strong the dollar is we've got a lot of global turmoil right now. We've got effectively 2 wars happening in Israel and in Ukraine, which are not resolved. And that is holding back, I think, some activity. Otherwise, I think we would see a very resilient cross-border M&A market right now.
Even not cross-border, I mean, you're obviously steeped in the tech space now, and you're clearly aware of all of the regulations or potential antitrust issues being raised, particularly against some of these big tech companies here. And that seems to have put a chill on some of those acquisitions, particularly some of those bolt-on acquisitions that we used to see all the time from the big companies like Microsoft, Alphabet, et cetera.
It is a huge factor. I mean, look at how long it took Microsoft to get approval for Activision. Look how long it took Broadcom to get approval for VMware. Now, those are giant deals, but it's very difficult if you are a large company like a Microsoft, like an Apple, Amazon, Broadcom, and you're thinking about a significant game-changing acquisition. You know it's going to take a long time. And the boardroom is going to have to wonder, okay, if it takes me a year, year and a half to get that deal closed, what's the target going to look like at that point in time?
Yeah.
What employees are left? Have customers left? And so I do think it's a factor, but it's really a factor for the largest tech companies, at least in my ecosystem. Mid-sized companies don't have that issue as much today.
That's a good point.
The FTC's already had its intended impact. It doesn't need to win these cases. It just needs to create, you know, as Ron said, the chill in the boardroom, which it has, most certainly. So it's very asymmetric, the effort that you have to go through to get a transaction to announcement and then to close versus the costs that you're going to have on the other side expended by a governmental agency. It's not a fair fight.
Yeah.
And they're in it to make a point, and you're in it to close and win, and it just leads to outcomes that are having this chilling effect on the market.
Yeah, but like with Microsoft, I mean, some companies have fought back and won.
Yep.
So I mean, not to minimize what you're saying here, but is there a case to be made, at least for those folks that have the resources and more importantly the time, is it worth trying to move forward with these deals?
Increases the cost of acquisition, right? So for the buyer now, in addition to thinking about what I'm going to pay the seller, I have two incremental costs. My litigation cost, which is pretty substantial, and second, what Ron was referencing, retention. Because now you've got to think about holding that target business together such that you're actually getting value of what you're paying, which means you need to keep the people there, and you need to have incentives for them to continue performing. You've got to be a lot more careful about how you write the covenants between signing and closing so that there is enough flexibility but not too much flexibility and all of that. And so it becomes a lot more tricky, and finally all of that translates to money, because that is a chunk of money that is not getting paid to the seller or is increasing the buyer's cost of the same deal.
Yeah. I think the entry cost to M&A is much higher than it used to be, and so ironically, it's actually led to this desire to do larger transactions, because companies are saying, if I'm going to enter into this arena of M&A, which takes time and money and resource, involves risk of closure, I may not be getting at closing what I think I bought at signing. It creates this dynamic where if I'm going to do it, it's got to be bigger, which of course flies in the face of the antitrust regulators' policy perspective on trying to make sure we keep companies a little smaller and more distributed and more competitive with each other, as opposed to consolidating and having larger players at hyperscale, which is what you see all through tech certainly, and in other industries where you have these hyperscale players.
If I could just add in one element that is maybe a little bit positive, and for all of us who are practitioners, what we're also seeing is some complexity in these transactions, which gives room for us to add value as bankers, which is sometimes positive. In some of these, we're in a couple of these situations that are tied up in the regulatory, geopolitical issues, and being around the hoop, being able to deliver creative solutions to allow companies that, if they're willing to divest certain assets, they're parts of it, partner on certain pieces, find a domestic partner to resolve certain issues, there are really creative, interesting solutions that can get you to the finish line. So there's closure risk around it in the market today, but I feel for our franchise and for all of us, the opportunity to add value in those situations and to really help guide our clients through some of these prickly situations can be quite rewarding.
Yeah, no, I couldn't agree more. I think the way in which every single situation needs to be looked at now, it's much more multifaceted, and you really need to consider a higher number of dimensions that probably 10 years ago, I mean, were neglected, including ESG elements, regulatory aspects, geopolitical, how things can develop. A couple of data points, I think, regarding the the cross-border situation. I mean, between the early 2000s and 10 years ago, I mean, about 35%, so more than a third of the global values transacted actually were represented by cross-border deals. And then since 12, 16, this number has gone down, 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 with China becoming almost muted. Even Europe, in particular West Europe, I think both in terms of volumes and values, really declining significantly, and the US actually becoming more and more important. And now we have reached probably a throat. I mean, if you look at the current level of cross-border deals, it's not probably even a quarter of the overall M&A market. So it's a big, big gap in less than 10 years. And this has been caused by a variety of different reasons. The US and US deals, if you look at the 20-some $10 billion plus deals announced between January and now, 18 of those actually had the US companies involved. So just to give you an idea of how relevant the US is going to be in this large deal space. And the vast majority of the cross-border activity actually is in between countries that are friends. So if you look at the UK and the US, if you look at the Europeans and the US, I mean, there's a clear trend towards this scenario, which we call Cold War II type of scenario, where there are two blocks, and we see if there's a hope that actually the cross-border activity can resume, that especially in those sectors that are not considered super strategic, and more sectors actually are becoming strategic, including food and others. I mean, there's a pickup again in transaction, at least between countries that are considering themselves part of the same block.
But I am curious how strong that friendship is, and this actually dovetails with an audience question, which is about how difficult it would be for a non-US company to do that. Even the ones, I mean, we've seen this with a couple of companies, including UK and the US and the cybersecurity space, where these issues have been raised. I mean, the deal still kind of got the go-ahead, but there are a lot of people that took a look at it and said, you know, just because you're our ally doesn't mean we want you in our company, so to speak. Andrew, we want to take that?
Yeah, look, we have a fairly rigorous and complex set of procedures that you have to go through to acquire a U.S. company. We have through the Treasury Department something called CFIUS. If a non-U.S. entity is buying into a U.S. company, it goes typically through CFIUS review. That used to be not much of an event, but now you have increased awareness and heightened awareness about areas that on the surface may not present national security risk or national security interest. So you have to take a deeper and deeper dive into some of these assets, and I think the regulators need to think 3 or 4 steps ahead. So these deals still happen. You can have particularly allied nations buying sensitive businesses in the United States, but there's definitely an increased scrutiny, increased awareness. And I'd say those deals are, again, on a longer timeline to get closed because they have a much more high level of review than they typically would have.
I want to pivot to another audience question, and I'll pose this to you, Anu. This has to do with portfolio companies where the sponsors are feeling kind of leverage, cash flow, covenant type of stress here. The question is that as they've held on and even put in new equity, what happens if we get into a higher for longer environment? Does that dampen M&A for those folks?
Yeah, I don't know whether people heard the private equity panel that was here. I think that was one of the main themes that people were talking about, is when you look at this number of companies that are there, the 28,000 portfolio companies, there are several of them that people have held for 5+ years. Right, about 25% of those companies, I think, are more than 5+ years. So they are kind of getting long in the tooth there. And it could be challenging in terms of thinking about traditional exit. So traditional exit would be what? Sell 100% of it to another private equity firm, sell 100% of it to a strategic, or take the company public. And so what we have now seeing, and what we heard from the PE panel was what they all expect to do a lot more of is different ways of exiting. And beyond just the continuation fund, which has almost become like a negative word now, but beyond just thinking about it as partial monetization, several ways in which either you're going to keep a stake, you're going to maybe combine 2 different sponsors portfolio companies. So you're doing a strategic merger of two different companies, trying to get some cost out. Again, as long as the debt triggering is not prohibitively expensive. But sometimes that can be a deleveraging transaction. Thinking of taking an asset and putting it into an SPV and raising money around that, and various derivations of partial monetization, continued ownership, and bringing in a fresh equity. With, some people call it evergreen IPO or private IPO, various versions of saying that I'm going to go raise capital on an asset, but the company is not going public.
Yeah. And this kind of gets to, I think, what Alan was talking about. You almost seemed giddy when you were talking about all the extra advice that people are asking you for here. But it kind of gets to that idea of really, does need to be a lot more guidance in this environment than in the past.
I feel like I keep chiming in slightly more optimistically. There are 28,000 companies. Most of them are good companies, right? The good news is that maybe they're slightly over-levered or over-levered for some portion of that, but I look at our portfolio companies, and again, we have lending exposure to these companies, so we see we're tracking how they're performing. The performance is quite good. So we're optimistic that equity markets have to normalize, right? That has to, once again, you talk about the $100 trillion of value. There is a broad, deep capital market, particularly here in the US, for those companies, so that has to reopen. We love the creativity, right? As was indicated, our sponsors are being more creative around how to raise fresh capital, bring in new partners. In my mind, what they're struggling to also do is retain some of the upside in order to deliver on some of those returns while shaking loose some of the companies in their portfolio. And these are creating opportunities for us to access new investors, right? The private capital markets that we keep talking about. There's obviously been mostly focused on private credit, but there's lots of appetite for private equity, right? The growth in family offices, in alternative capital pools, being able to access those types of pools of capital to bring in minority investors, to retain some upside again and create some value for their LPs along the way. We are also seeing increased usage of fund facilities, margin lending, various leverage tools that are allowing for access to capital to create some of this liquidity to just create more optionality for the sponsor. So we're seeing a lot of creative tools around this process, and eventually it will, we touched on this several times here today, that there's still a reluctance to accept the reality of pricing.
Yeah.
It's gotten better, and we love all of our children equally, but at times we have to let them go and move on with their lives, so that will happen.
And this actually dovetails with another audience question. I know it is about one of the comments you made earlier about the gap between buyers and sellers, and this particular attendee is asking about the delta between a public and private market valuations, and what sort of data you see that justifies your view of that delta right now.
So the public-private valuation is, where is the stock trading? So the rationale for take private. So there's two themes there, actually. One is you look at a company, and especially because you've seen now decades-long flows from active to passive. So as a result, if you're a public company with a market cap of 1, 2, 3, 4 billion, something like that, majority of your ownership is passive. And you could come and announce blockbuster earnings, have a really good quarter, and you don't see your stock price move.
Right.
And that can be very frustrating when it hasn't been that easy to deliver that results. And to get an active manager interested in a company, you have to have enough scale for that active manager to deliver returns on the investment that they are making. So that is what is causing a little bit of this private-public valuation mismatch. But then somebody needs to have a thesis and a belief that if I take this company private, I'm going to do something with it. And that's the easier part. The harder part is, how do I exit? If it's a strategic that is buying it, that's different. But if it's a private equity firm, they are spending a lot more time thinking about the traditional thing was, okay, I'll take it private, and in 3 to 5 years, I'll take it public again. And you can still have that view, because I agree with Alan, at some point of time, the equity markets will come back. But you have to have judgment around that exit multiple. That is a little bit uninformed by the markets, because you don't know what the current equity market valuations or future equity markets, so you have to have a point of view. But some people are taking that point of view and saying, I can pay 40, 50% premium and still make the math work.
Yeah.
The second part of it is when a company, in their own, and I'll give you like a simple example, in 21, the stock was at 100. Today, it may be at 50, and you're getting $80, but you still have 100 in your head. And that's hard, because there is nothing else to the 100 other than it's in your head. So that's where it becomes a bit difficult to say, how does a buyer justify that? And sometimes we get these deals done. Again, we have to be very creative in terms of putting in some structure to bridge the gap and say that, okay, if A, B, C, D happens, then you'll get an incremental $20 or $10 or something like that. The downside, you may ask, why can't you do it every time? Because if you're a strategic buying the company, I don't really want to keep it separate.
Yeah.
I want to integrate it, and I want to get the benefit of the synergies immediately. But if you are a private equity firm, or for whatever reason you're going to keep it separate, or you have a way of tracking a particular piece of performance, because the company has made some investment and you as yet don't know what the return on that is going to be.
Yeah.
And you say, if I get the return, I'll pay you for that.
It's a very interesting topic. And in any given industry, the biggest companies and often the best companies are the public ones. They're trading at higher multiples typically. And so if you're a private company thinking about a monetization event, you generally have kind of 3 paths. You could go public, you could do some type of a levered recap and take a dividend, or you could think about a sale of your company. I mentioned at the beginning, the IPO market has been effectively dormant for a couple of years now. So if you take that off the table and you think about the impact of higher rates on leverage, that drives you to the M&A market. And in many ways, it has become gee, I can't go public, so therefore I might as well explore a potential sale of my company. But there certainly is a mismatch between where public equities are trading in many industries and where private valuations are, which is being exacerbated by higher rates.
Well, so on the point of exits, and I'll pose this to you, Andrew. This is another audience question, and the audience member cites some data showing 2,000 private companies slated to run out of money in 2024. Who knows if that's true, but we do know there are a lot of private companies out there struggling. And the question really is you mentioned earlier all this dry powder that's already out there, but if we do get a huge influx of new assets onto the markets, how much does that actually affect the health of the M&A market?
There's an unbelievable mismatch of capital that's available and the assets that are the users of the capital, the companies that are in need of capital. In and of itself, in any given period of time, that's not problematic because the dry powder is there for many years. It's not there for a Tuesday morning to deploy, so you've got time to deploy it. There are companies that in a higher for longer rate environment are going to start to see earnings pressure. They probably are in a vintage of financing where if you go back and look at where they did some of the original financing or where a private equity buyer may have transacted, they're probably at a very low rate, and probably the underwriting assumptions about future cost of capital and what an exit might look like probably don't comport with reality today. The reality on the ground today is that we've got higher rates, we've got higher cost of capital, and I don't think it applies to all of the 28,000 companies that were referenced earlier, and maybe not most of them, but many of them have a fundamental flaw, which is that the entry price was too high. And that becomes an incredible inhibitor to future transactions. And that's why you see increasing structure, increasing complexity, creativity required, all of which are good for our business, and it creates a full employment act for advisors and for lawyers and bankers, which is great.
Yeah.
But the fundamental issue really at the heart of it is mathematics, and the valuations are just too high, and it makes it very hard to part with because of the earlier comment, a news comment, you're anchored
Yeah.
And you're not only anchored in a boardroom looking at $100 stock, that's one type of anchoring. There's real anchoring when you've made an investment at 11 or 12 times cash flow, and some of these things are trading at 7 or 8, and you can't get anywhere near the leverage that you could get, 5 or 6 years ago. So that creates an incredible inhibitor to transactions. I'm still much more of a believer that strategics will continue to drive M&A and drive the recovery in M&A. I think that private equity should come back to the market. They've got the capacity, obviously, to do that.
Right.
But there's a supply chain issue in private equity, which is that they've got 2.67, depends who you talk to, something like that, trillion of dry powder.
Yeah.
But a lot of the LPs on the back end are saying, give me some more monetizations first before you call that capital. So it's not readily available or as readily available as people think.
Right.
You need more of these monetizations. You need IPOs. We've seen a couple recently that have been quite promising. Viking most recently was a very good IPO for TPG and others. You've had continuation vehicles continue to be popular. So there's the plumbing is starting to kind of clear out, but there's still some problems in the sponsor-held world that's going to take some time to work through.
Andrea, did you have a point you wanted to make?
Yeah, no, I just want to say that the number of companies listed on the stock market has been going down for the last 20 years. I mean, there's a structural issue here in the market that we're not going to solve today, but for sure is impacting this situation. And we have this clogged exit route now, but it's not going to get any better unless we solve for the structural issues in the capital market. That is in the last 20 years. I mean, we've seen less and less appeal in listing, and this is a matter of fact. I think regulators need really to take stock of this, and probably we should be more creative regarding other ways of negotiating deals outside the official stock market, because the problem is only growing.
Yeah. And when we talk so much about what's happening in the here and now, and maybe I'll go back to the optimism, Alan, that I think you were trying to bring in here. But I mean, you guys have to also be thinking a lot now about some of these bigger, broader structural changes in our economy, in our world, and how that's going to drive deals and really just drive our economy here. I mean, what are the more sort of bigger potential things, the ones you really think has some substance behind it, Alan?
I'll just start and follow up with Andrea's point, which I feel is now starting to get better attention, but is a huge structural issue for our markets, and that is the balance between passive and active investing, right? The shift, if you go back 20, 30 years when this came, the whole concept came into being. I don't think anybody anticipated that it would dominate the market the way it is, that for most of our public companies, the largest shareholders are all the passive investors. And the whole concept is predicated on active investors setting a price which therefore can be copied by the passive investors. And that probably works when passive investing is 10, maybe 15 or 20% of the market. When it's 50% plus, it doesn't work, right? It's very hard to go on an IPO roadshow and talk to a computer and try to convince them to participate in your deal. So you're talking about dislocations in financing markets that were probably unanticipated, and the unintended consequences we're now dealing with, and there has to be some level of balance. And again, if everybody continues to believe that passive investing is the only way to achieve a reasonable rate of return, eventually the market will go away, right? There will be nothing left. So you have to reach a point where cooler heads step in and say there has to be some way to mitigate this because it's unhealthy for our market. So I'll just stop with that one element that over time we're going to have to address.
Yeah.
Real quickly, I wanted to mention one thing, which is AI. I think in the spirit of Elon Musk having been here yesterday, we should bring that up. It is pervasive.
Were you standing in line, that long line to get the thing last night?
It is pervasive in the boardroom. what should our AI strategy be? And in most cases, companies don't really know, and they're looking to M&A to solve some of those gaps. We went back and looked at of the S&P 500, how often was AI being mentioned by CEOs on earnings calls? 3 years ago, it was about 10%. Now it's over half, and it's not just technology companies. And so M&A will drive companies to move into AI. Many of those deals will be nothing more than acquiring groups of people and figuring out how to build a product. But that is certainly a pervasive theme in the boardroom right now.
Yeah. I'd add another sentence to that, which is just going to, I think, fuel additional M&A, which is the traditional build versus buy analysis. It's dead. Outside of technology, that is dead because it just takes too long. Transition and technology develop too quickly. By the time you build it, you've lost market position. The competitors aren't sitting around waiting for you to catch up. So I think that is really a very significant stimulant of future M&A activity. And again, outside of tech, where there's still plenty of building going on, thankfully, you really just don't see much of this build versus buy decision, which used to be pervasive at least 30 years ago when I started in the business. There was always a discussion, should we buy something or build it? You don't hear that anymore.
Yeah, I know.
When you think of kind of where the puck is going and where could you see the activity infrastructure, I'd say the number of private equity firms who have created an infrastructure fund sleeve, and the activity there continues to be high, even though the other part of private equity may be quieter. Energy transition, that's a big theme, and you see a ton of it, even whether that is tech companies trying to figure out how to power their data centers, to every other company trying to figure out energy transition. And deals happening across sectors. So industrial companies looking at tech and healthcare, consumer healthcare, retail healthcare, media companies looking at technology. So, in our parlance, we say horizontal, vertical kind of mergers. But that's, I think, another interesting direction of travel, where the traditional silos of sectors no longer apply in terms of how people are thinking about growth.
And Andrea, you're going to get the last word here. I guess what's next year's big report going to say?
I think we have said it all probably. I totally agree with the AI part. I mean, on top of every board's agenda, I think it's very complicated for them really to pick the right horses now, and that's actually what held back M&A in 23. I think now we see more assertiveness and more precisions regarding what kind of teams, technologies can be acquired really to get a competitive advantage. The other additional theme probably is worth mentioning is really the geo aspect. I mean, there's a huge amount of capital, for example, in the Middle East. This is one stream that I think is worth following, especially outbound. I think there are markets that have been subdued for many years with a huge potential for value creation. Japan is one, for example, where a lot of is happening. We are looking at that with great attention because there's really a great opportunity, really, and M&A is picking up there.
All right, really appreciate it. So smart. Please give a round of applause for Anu, Andrew, Ron, Andrea, and Alan. Thank you, everyone.
We hope you enjoyed the discussion. Please make your way to your next session.